Welcome to the deep dive. Today we're going deep on Nifty Indices.
Oh, yeah.
You know those benchmarks of the Indian stock market?
Right.
We're going to figure out how they're made, what makes them special, and why should you even care?
Exciting stuff. We've got these excerpts from a technical document all about how Nifty builds these indices.
Right.
It's a little dense, I'll admit.
Yeah,
But we're going to break it down, make it easy to understand.
perfect. Because I'm already kind of intrigued.
Okay.
I mean, I know Nifty 50, of course, but this document hints at a whole universe of Nifty indices.
Right.
So where do we even start? What kind of variety are we talking about?
Well, you've got indices for pretty much every sector you can imagine.
Okay.
Like automobiles, pharmaceuticals, but it goes way beyond that.
Okay.
There are indices that cater to specific investing styles, like growth investing or value investing. And there are even indices that align with ethical principles, like the Nifty Shariah index.
Well, hold on. I'm trying to wrap my head around this. So if I'm interested in, say, small and medium enterprises, there's a Nifty index for that.
Absolutely. There's the Nifty SME Emerge Index. It's designed to track the performance of these up-and-coming companies.
Wow.
And if you're really into the digital economy, there's the Nifty India Digital Index.
Okay.
It captures the growth of companies in e-commerce, fintech, all those digital sectors.
So whether you're a seasoned investor or just starting out,
Yep.
there's a Nifty index that caters to you.
That's the idea.
That's amazing. Okay. Now, I've heard these indices are weighted differently.
Yeah.
Can you explain what that means, why it matters?
Sure. Most indices, like the Nifty 50, are weighted by market capitalization.
Okay.
This means that companies with the larger market value, giants like Reliance or TCS,
Right. Yeah.
they have a bigger influence on the index's movements.
So the bigger the company, the more it sways the index.
It's kind of like a popularity contest where the biggest companies get the most votes.
Got it. But this document mentions other weighting methods too, like
Yeah.
equal weighted indices.
Yeah.
Why would I choose that?
Well, equal weighted indices like the Nifty 50 equal weight,
Okay.
they give each company an equal, say, regardless of its size.
Mm.
This can be appealing if you're a little worried about overexposure to those mega cap companies and want a more balanced approach.
Interesting. It's like leveling the playing field.
Exactly.
Now, I've also come across this term, factor-based indices.
Right.
What are those and why should investors care?
So factor-based indices, they focus on specific characteristics or factors that research has shown can potentially lead to outperformance.
Okay.
For example, the Nifty Midcap 150 Momentum 50 Index, it targets companies with strong recent price trends,
Okay.
suggesting they're, riding a wave of positive momentum.
So you're betting on those companies with the wind in their sails, hoping that momentum continues.
Yeah, basically.
What about quality as a factor? Is there an index for that?
You bet. The Nifty 200 Quality 30 Index selects companies based on their profitability, financial stability, and earnings consistency.
So if you're a buy and hold investor looking for companies with solid track records, this is the index to watch.
Exactly.
Okay, and then there are low volatility indices.
Right.
What's the appeal of those?
Low volatility indices like the Nifty Low Volatility 50 aim to provide a smoother ride by choosing companies with historically stable price movements.
All right.
So this is attractive if you're risk averse and you prefer a portfolio that doesn't swing wildly with every market fluctuation.
Makes sense. It's like choosing a calm sailboat over a speedboat.
Yeah, a good analogy.
Okay, now before we get too deep into specific indices, this document also mentions these terms alpha and beta.
Right.
Can you give us a quick refresher? What do those mean in this context?
Sure, let's start with beta.
Okay.
Think of it as a measure of how sensitive a stock is to market movements.
Okay.
A beta of 1 means the stock tends to move in line with the market. Higher beta means more volatility, while lower beta means less.
So a high beta stock is like that friend who reacts dramatically to everything. And a low beta stock is more like the calm, collected one.
That's a good way to put it.
Got it. Now what about alpha?
Alpha measures how much a stock or portfolio has returned above and beyond what you'd expect based on its beta.
Okay.
So it's essentially a measure of outperformance, the extra edge that kind of sets skilled investors apart.
So a positive alpha is the holy grail for investors.
Pretty much.
That extra bit of return that makes all the difference. But how does Nifty factor alpha into its indices?
Well, there are indices specifically designed to target alpha.
Okay.
For example, the Nifty Alpha Low Volatility 30 Index.
Okay.
It aims to achieve outperformance while keeping volatility in check.
So it's like trying to get the best of both worlds, high returns with less risk.
Exactly.
Nifty Alpha Low Volatility 33. I'm writing that down.
Good one.
Okay, so we've covered the different types of Nifty indices and their weighting methods, but how do they actually choose which companies make the cut for these indices?
Right.
It can't be random, right?
Definitely not. Each Nifty index has specific selection criteria. And that's where things get really interesting.
Okay, this is where I'm all ears, spill the beans.
All right, we'll take a look at the Nifty Auto Index.
Okay.
It doesn't just include like traditional car manufacturers anymore.
Oh.
It also includes companies involved in the production of electric vehicles.
So they're adapting to the changing landscape.
Exactly, acknowledging the rise of sustainable transportation.
Okay, that's a great example of how these indices reflect current trends. Are there any other criteria that stand out?
Let's talk about the Nifty 100 Index.
Okay.
One of its key requirements is that companies must be listed on NSE's Futures and Options segment, or F&O segment.
Okay.
This is where traders buy and sell futures and options contracts, which are basically bets on the future price movements of assets like stocks.
Okay.
Being listed on the F&O segment means a stock is highly liquid and actively traded, which is essential for inclusion in an index like the Nifty 100.
So it's like a badge of honor for a stock, signifying that it's like a major player in the market.
Yeah, you could say that.
Now, what about smaller companies? How do they get a chance to be included in a Nifty index?
The Nifty Small Cap 50 Index is a great example.
Okay.
It selects companies based on their free float, market capitalization, A&D, average daily turnover.
I understand market cap. But what exactly is average daily turnover, and why does it matter for small cap companies?
Average daily turnover tells you how much a stock is traded on a daily basis.
Okay.
For small cap companies, having high turnover is crucial because it indicates liquidity.
Right.
If there's not enough trading volume, it becomes
It's like a well-oiled machine with each part carefully calibrated.
Yeah.
But as we've gone along, we've encountered a few technical terms.
Sure.
Could you help us decipher them?
Absolutely. One term that pops up is investable weight factor, or IWF.
Okay.
This sounds complicated, but it's actually a simple concept.
Okay.
It makes sure that only the truly public portion of a company's shares is considered for the index.
Break that down for us. What does truly public actually mean?
Not all outstanding shares of a company are freely available for trading.
Right.
Some might be held by promoters or government entities or other strategic investors.
Okay.
These shares are essentially locked up and not really available to the public.
Okay.
The IWF filters these out and considers only those shares that are readily available to the public for trading.
So the IWF helps me, the investor, understand how much of a company's stock is actually available for trading.
That's the idea.
It's like knowing how much of a pie I can actually buy, not just how big the whole pie is.
Exactly.
What about impact cost? I've seen that term a few times.
Yeah, impact cost is crucial for understanding liquidity.
Right.
It's basically the cost of your trading activity on the market price.
Okay.
Imagine trying to buy a large number of shares of a small cap company with low trading volume.
Right.
Your buying frenzy might push the price up, making it more expensive for you to buy those shares.
Okay.
That's impact cost, the effect of your trade on the market price.
So it was like the ripple effect of a big splash. The larger your trade, the bigger the wave.
Precisely.
It makes sense that Nifty considers impact cost when selecting companies, especially those where liquidity might be a concern.
Right.
We've covered a lot of ground from the different types of Nifty indices to their intricate selection criteria.
Yeah, we have.
But we can't forget about corporate actions, those events like mergers, demergers, and stock splits that can really shake things up.
Oh, yeah.
How does Nifty handle those?
Nifty handles them with meticulous precision.
Right.
They have detailed guidelines for adjusting the indices whenever a corporate action occurs to ensure continuity and accuracy.
So they don't just sit back and let these events like throw the indices into chaos.
No.
They actively step in to maintain order.
Exactly. It's like having a rule book for every possible scenario,
Right.
making sure the indices accurately reflect the underlying company's performance, even when things get a little complicated.
Okay, but we can delve deeper into those adjustments in part 2 of our deep dive.
Right.
But before we move on, we should talk about the elephant in the room, the power of dividends.
Absolutely. They play a crucial role in an investor's overall returns.
Okay, I'm all ears. Explain the difference and why I should care.
All right. Well, price return indices like the standard Nifty 50,
Yeah.
they simply track changes in stock prices. They ignore dividends.
Okay.
Total return indices, on the other hand, factor in dividends, assuming they're reinvested back into the index.
So a total return index gives a more complete picture.
Yes, because those dividends can really add up over time.
Okay, and Nifty has indices that specifically focus on dividends.
Right.
Like the Nifty 50 Dividend Points Index,
Yes, it tracks the total dividend points of Nifty 50 companies.
giving investors a clear picture of the income generated by those companies.
Exactly.
Nifty 50 Dividend Points Index. Got it. I'm sensing a theme here. There's a Nifty index for pretty much everything.
There's more.
Oh, there's more.
There's also net total return, or NTR.
Okay.
It takes total return a step further by factoring in not only dividends, but also taxes.
Okay, now we're talking about real-world returns, the kind that actually hit our bank accounts.
Exactly. NTR gives you the complete picture considering the impact of both dividends and taxes.
NTR provides a more accurate picture of an investor's potential gains.
Precisely.
Wow, this is more intricate than I ever imagined. We've uncovered the vast array of Nifty indices, their unique weighting methods, those intriguing selection criteria, and even how dividends and taxes play a role.
It's a lot to take in.
I'm already feeling more informed,
Good.
but I know there's more to come, right?
Yeah. Absolutely. In the next part of our deep dive, we'll delve deeper into those corporate actions, unpack even more jargon, and really explore how these indices can empower you to make more informed investment decisions.
I can't wait to see you in part 2.
See you then.
Welcome back to our deep dive into Nifty indices.
Yep.
In part 1, we uncovered a whole universe of indices, their unique weighting methods, and those fascinating selection criteria.
Right.
Now we're ready to unpack even more.
All right, let's delve deeper into those selection criteria then.
Okay.
Remember how we talked about the Nifty 100 index requiring companies to be listed on the F&O segment? Well,
Yeah.
there's more to it than just that.
Oh, I knew there had to be more layers to this onion.
The document specifies that for a non-F&O stock to be eligible for the Nifty 100,
Okay.
it shouldn't have hit the upper or lower circuit price band too frequently in the past 6 months.
Okay, you're going to have to break that down for me. What exactly is a circuit price band?
Think of it as a speed limit for stock prices. It's a mechanism used by stock exchanges to prevent extreme price fluctuations within a single trading day.
Okay.
Imagine a stock suddenly shooting up 20% in a matter of minutes.
Right.
That could create chaos and panic in the market.
Yeah.
Circuit breakers are designed to prevent those wild swings.
So it's like a safety net preventing those dramatic spikes or crashes that can make investors nervous.
Exactly.
But why would hitting the circuit breaker too often disqualify a company from the Nifty 100?
It all comes down to stability and predictability.
Okay.
Companies that frequently hit those price limits are often seen as more volatile and risky,
Right.
which might not align with the profile of a large cap index like the Nifty 100.
Makes sense.
And think of it like this. You probably wouldn't want a roller coaster as your primary mode of transportation, right?
Right.
You'd prefer something more reliable and steady, especially if you're going on a long journey.
Okay, the Nifty 100 is meant to represent those blue chip companies that provide a sense of stability and long-term growth potential.
Exactly.
We also touched upon the Nifty Small Cap 50 Index and its focus on liquidity.
Right.
But what about those mid-cap companies? What are the criteria for joining that club?
The Nifty Midcap 150 Index has its own set of requirements.
Okay.
For instance, it considers a company's rank based on both its 6-month average free float market capitalization and average daily turnover.
So it's a balancing act between size and liquidity.
Right.
They're looking for companies that are not only mid-sized but also actively traded,
Exactly.
ensuring that investors can easily buy and sell shares without causing major price swings.
And to make things even more interesting,
Okay.
they also look at a company's rank within the Nifty Small Cap 250 Index.
Wait, a company can actually graduate from the small cap index to the mid cap index.
That's right. It shows how dynamic the Indian market is and how companies can climb the ladder based on their performance.
Sounds like moving up to the big leagues.
Exactly. It's all part of Nifty's goal to provide investors with a comprehensive set of benchmarks
Right.
that reflect the diverse landscape of the Indian market.
This is getting more and more fascinating. It's like a living ecosystem,
It is.
constantly evolving as companies grow and shift positions within the market.
Yeah,
Now, we promised to decode more of those technical terms we've encountered along the way.
right.
Let's shed some light on a few more. One term that often comes up is corporate actions.
Yeah, these are events like mergers, acquisitions, stock splits, and the like.
Oh, yes, those events that can make investors scramble.
Yeah.
But why are they so important in the context of indices?
Because corporate actions can significantly impact a company's share price and market capitalization.
Right.
And those are key factors in how Nifty constructs its indices.
So Nifty can't just ignore these events.
Nope.
They need a way to adjust the indices accordingly
Yes.
to make sure they still accurately reflect the underlying company's performance.
Precisely. Nifty has a detailed set of rules for handling corporate actions.
Well, I bet it's a complex rule book.
Yeah.
Give us a sneak peek. What are some of the key adjustments they make?
For events like bonus issues and stock splits, they adjust the number of shares outstanding and the stock price to keep the company's overall market capitalization unchanged.
So it's like a reshuffling of the deck.
Yeah.
The cards might look different, but the total value remains the same.
It's a good way to put it.
But what about those more complex events like mergers?
For mergers, the transfer company, the one being absorbed, is excluded from the index on the X date of the merger.
Hold on, back up for a second. X date. Another technical term?
It's simpler than it sounds. The X date is basically the cutoff date for determining which shareholders are eligible to receive a dividend. Or in this case, participate in a corporate action.
So on the X date of a merger, the acquired company says goodbye to the index.
That's right.
But what happens to the acquiring company? Do they just inherit the acquired company's weighting in the index?
Not quite that straightforward. The acquiring company's equity shares and investable weight factor are adjusted based on the terms of the merger.
So it's a careful recalibration taking into account the new combined entity's characteristics.
Exactly.
Makes sense. What about those spin-offs we talked about earlier?
Yeah.
Those demergers, where a company creates a separate independent entity.
Demergers are where things get really interesting. Nifty has specific guidelines for handling them, especially when a special pre-open session, or SPOS, is conducted by the exchange.
SPOS. Okay, I'm officially lost. Break this down for me.
A special pre-open session is a trading session conducted before the regular market hours. It's typically for handling specific events like demergers, giving investors a chance to adjust their positions before regular trading begins.
So it's like a pre-game warm-up, giving investors a chance to get their bearings before the main event.
Exactly.
But how does this SPOS affect Nifty's handling of demergers?
Well, if an STOS is conducted, the demerged company, that's the original company, remains in the index. But here's the twist. The spun-off entity is also temporarily included in the index at a constant price.
Wait a minute, they add both companies to the index? Isn't that double counting?
Not exactly. The spun-off entity is only included for a short period, usually 3 trading days. This ensures its value is accurately reflected in the index until it starts trading independently.
So it's like giving the spun-off company a temporary guest pass to the index while it gets settled in.
That's a good way to think about it.
It all comes back to ensuring the index's accuracy and continuity. But what if there's no SPOS? How does Nifty handle demergers then?
That's when they use what's called a dummy symbol.
Dummy symbol, right.
Yeah.
It's essentially a placeholder representing the spun-off entity's value until it gets listed and starts trading.
Exactly. It's like a stand-in for the real actor until they arrive on set.
But how do they determine the price of this dummy symbol?
Right. It can't just be a random number.
There has to be a method to the madness.
Of course. It's calculated based on the difference between the demerged company's closing price on the day before the X date and the price derived during a special pre-open session if one is conducted. If there's no SPOS, they use a theoretical price based on the demerger ratio.
Theoretical price demerger ratio. This is getting a bit complex. Could you give us a simple example to illustrate how this works?
Sure. Imagine Company A demerges a part of its business into Company B. Let's say the demerger ratio is 1.1, meaning for every share of Company A, shareholders receive 1 share of Company B.
I'm following so far.
Now let's assume Company A's closing price on the day before the X date is $100. If there's no SPOS, the dummy symbol representing Company B would be priced at $50, half of Company A's price.
So they're essentially splitting the value of the original company between the demerged company and the dummy symbol representing the spun-off entity.
Exactly.
This ensures the total value remains consistent, even though it's now represented by 2 separate entities.
Precisely. It's a clever way to maintain continuity and accuracy in the index, even during complex corporate events.
We've covered a lot of ground in this part of our deep dive.
We have.
From circuit breakers to special pre-open sessions and even those fascinating dummy symbols.
It's a lot.
I'm really starting to appreciate the level of detail that goes into constructing and maintaining these Nifty indices.
It's fascinating, isn't it? But there's still more to explore. In the final part of our deep dive, we'll zoom out and discuss how these indices reflect the broader dynamics of the Indian economy. We'll also leave you with some thought-provoking questions to ponder as you continue your investment journey.
Sounds great. See you in part 3.
See you then.
Welcome back for the final part of our Nifty Indices deep dive. We've journeyed through the different types of indices, explored their intricate selection criteria, and even tackled those complex corporate actions.
Yeah, it's been quite a ride.
It has. Now let's zoom out and look at the bigger picture. How do these indices reflect the evolving landscape of the Indian economy?
That's a great question. Nifty indices aren't just these static benchmarks.
Right.
They're like dynamic reflections of India's economic growth, shifting sectoral focus and evolving investment trends.
So they're like a mirror reflecting the dynamism of the Indian economy.
Exactly.
But can you give us some concrete examples? How are these indices mirroring India's economic transformation?
Well, just look at the emergence of indices like the Nifty India Digital and the Nifty EV and New Age Automotive.
Okay.
They clearly highlight the growing importance of technology and sustainability in the Indian economy.
Right.
These sectors are attracting so much investor interest, and Nifty is reflecting that shift
Right.
by creating benchmarks that track their performance.
It's like these indices are capturing the zeitgeist, the spirit of innovation and progress that's driving India forward.
Exactly.
What other indices point to this dynamic shift?
Well, the Nifty SME Emerge Index, focusing on small and medium enterprises, is another great example.
Yeah.
These companies are often the engines of growth, creating jobs and driving innovation at the grassroots level.
Right.
By creating an index specifically for SMEs, Nifty is recognizing their vital role in shaping India's economic future.
So it's not just about those big established players anymore.
Right.
Nifty is acknowledging the growing influence of these smaller, more agile companies.
Precisely, and let's not forget about the Nifty Shariah Index.
Right.
It reflects the growing demand for ethical and faith-based investments, showcasing the increasing awareness of social and environmental considerations among Indian investors.
It's fascinating how these indices are capturing not just financial performance, but also the values and priorities that are shaping India's investment landscape.
Absolutely. They're not just numbers. They tell a story about India's economic evolution.
They really do. Nifty indices are constantly evolving, mirroring the changing dynamics of the Indian economy and reflecting the diverse needs and aspirations of investors.
They provide a fascinating window into how India is growing and changing.
This deep dive has been an incredible journey. I feel like I've gained invaluable insights into this intricate world, and I'm definitely feeling more informed.
It's been a pleasure exploring this with you.
Thank you.
Remember, knowledge is power. The more you understand about these indices, the better equipped you'll be to navigate the Indian market and make those informed investment decisions.
Our exploration doesn't have to end here as you continue your investment journey. Think about this. How might these indices evolve further as India's economy continues to transform? What new sectors or investment themes might future indices focus on?
Those are great questions. To ponder the world of Nifty indices is vast and dynamic, offering a wealth of opportunities for those willing to delve in.
So keep exploring. Stay curious and happy investing.
Absolutely.
From the Deep Dive, thanks for listening.